So that's what we talked about, passive real estate investing strategies in 2024 that can help you replace multi-six-figure income. Typical disclaimer, not financial advisors. Today I'm planning on talking about stories of inspiration and passive investing market updates and what we're focusing on, why, and then any questions we can share. So I already talked a little bit about kind of since last time I was here, two years ago, why I was here. And I kind of just talked about the typical multifamily investing syndicator. What I did was due diligence presentation. I focused a lot on how to do due diligence, given my data analytics background. I know a lot of you here are engineers, and so like numbers is your best friend. I like to start with the why. It may be a little cheesy, but that's why we're here. From my side, I got married a little bit over 2.5 years ago. Last year, me and my family celebrated because after COVID, we are finally able to celebrate with some of my family members from China, and we moved my brother from China to the US, studying here as a junior, and I have my host family. So it was happy, and I might see myself as a wife, a sister, a founder with my business, and also a first generation immigrant and an influencer, meaning not necessarily from a social media standpoint, but more from the point of I like to influence people in a positive way in my life. And Grace Wen, who I also, see her as a mentor in life, given that she has a bigger family. Further in life, she not only retired herself, she also retired her parents in China as well. They were here and then they retired them, and then they're in China, kind of going back and forth as well. So in terms of her journey, my journey, she's definitely ahead of me in the experiences. I've been investing in real estate since 2019, and I'm using a data analytics driven background with my master's in data analytics and kind of the buying, selling corporate experiences as well. And I live in Northwest Arkansas. So I got into passive investing because of tenants and toilets. It was just too much work. But Grace has her story even to a bigger extent. And I got into active investing because I wanted to, one, to really build an empire to help others. It's a passion of mine. And also it's an additional revenue stream for myself as well. But when I met Grace, I see how she has gone through her journey, and I quickly realized that I really don't want to continue to do coaching or a partnership, but really be more of a passive investor, investing alongside of my passive investors. The reason I say that is we'll learn from her story. She was a full-time real estate investor, active investor. She built her portfolio to 2 million plus in values, between 130 doors owned by herself, with single family, multifamily, and some of them mobile home parks with co-general partnerships. And then she, when she found the holy grail of passive investing, which a lot of you have heard 10,000 times on, she passively invested into 4,500 units of multifamily, as well as some alternative investments like ATM fund, debt fund, short-term rental fund. She actually was one of my passive investors before we started working together. And she did passive investing, obviously, like seeing her kids, and she was actually, telling me about stories where she felt guilty. She has two kids. Her older kids, she was really busy taking not only her pharmacist job, weird hours, but also working as a landlord. So she felt really bad with her older daughter because she never really got to spend as much time with her compared to her youngest son. So when she finally had enough, she decided to figure out to do passive investing. She figured that when she started investing, her strategy was fix and flip or burr. What she saw was that the fix and flip and burr in her area, Seattle, you can't really get much of a cash flow, after a fix and flip, and given how much money you put in there compared to what you put in with a burr strategy. So she wanted to do the Class C apartments, and she has just. I always thought that was crazy stories people talk about, but then with her portfolios, she actually had crazy stories. When we were on the phone, like talk and then chatting, and she's like in China traveling. She had like a leak in the apartment. She spent $50,000 diagnosing like what's going on, working with different experts, and a tree fell into the house. It's like Murphy's Law to her. I mean, I'm sure there's people that doesn't have problems, and someone's like dying in the apartment. It's like crazy stories. She realized she was just not getting the time back. So she really, going back to her why, she started trying to figure out like what is it that I'm trying to do? Like, we're here for the long haul. Like, you know, I've done all this learning, I've done all this investing, but I'm not really seeing what I wanted to have, the passive income piece. How can I really enable that? So when she looked at her journey, she starts putting the numbers together. I'm gonna stop sharing a little bit because what she started doing, and the reason I talk about her story is because she's already done it. She she started looking at, hey, what is it that really I want to do? Like, if I want to spend time, like where do I really want to spend time? Is passive investing is really right for me? Or should I continue to scale in the active side? It's not like active is evil or anything. You can still be very successful being an active investor. But what happens is she realizes that means I have to scale. I can't just replace my income in a way and be somewhat passive unless I continue to scale. Continue to scale, that means I continue to hire people and manage people. She realized that's not really a path that she wanted to have. She wanted to be more on the passive side because continue to manage and scale. Because at what point that's enough, right? Like to her, that's a big question. So she sat down and wrote some of the numbers, like how much do I really need to replace my income now? But not just now, 10, 15 years, for my kids, what we plan for them in terms of colleges, and for her parents that she wanted to retire, and all this legacy planning. So she kind of had these numbers. And then she starts doing this math of, okay, so how much time am I spending my property management or even interacting with my property management? And how much cash flow am I really getting? Okay, if I'm getting depreciations or if I'm getting amortization on my loan, like how much that is. If I assume 3% increase of the property value on a yearly basis or 2%, whatever the market you're in, what would that look like? So she basically kind of came up with in terms of a requirement for her passive investment, like she basically came up with a number. If I can get consistently between 10 to 16%, nothing crazy like 30%, 20, I'm just talking 10 to 16% consistently on an annual basis to continue investing my money, like I'll be in a really good spot because my time costs money, not just time, but stress, the quality of life, like all that. She tried to, as to the best she can, put a number next to it. And she realized that really passive investing is the way to go. So basically right now, I was sharing the screen here and, you know, just what I want to highlight here is ignore the, can you see my screen? Yeah, ignore the wiring money part. That was used for another slide. But essentially she did all this learning, all this investing. She got to financial independence. She got to financial freedom. So she's like thinking, I have the freedom, but I don't really necessarily have the time. And with the legacy I want to build, the significance I want to have in my kids' life, in my parents' life, and the legacy I want to have, like, how can I enable that? So she basically tried to quantify that and figured, that's the magic numbers, 10 to 16%. And for her, the big thing was lower risk. I don't care about, crazy returns. I'm not going to invest in probably Bitcoin related stuff and anything that has significant risks for most of my portfolios. Maybe, maybe 10 to 15% I'll do that, but for most of my portfolio, it's just a stable 10 to 16%. So that's essentially what she did. And through that process, that's how we met each other. And she invested in one of my deals and we really connected on our values. And she was doing some co-general partnerships with people already, but she's like, this whole co-general partnerships. I think someone messaged me. Let me revisit that question a little bit. But this whole general partnerships is actually taking unnecessary risks as well, and also doing a lot of this unnecessary work. Rather just being like in a true limited partner position, allow my interest for the people that put their trust in me. So that's how we got together and launched our Freedom Growth Fund. And the foundation is capital preservation and consistent cash flowing with interest opportunities, with a few of, some of the small equity upside opportunity, especially considering the current state of the economy here. So, this is you guys probably have seen this quite often, in terms of the inflation, right? Like during COVID, right after COVID, how we experienced the inflation being so high, sometimes close to 10%. I mean, recently we're in the threes, mid to high threes. So it's unlikely that the interest rate will continue to drop or go up at this point. But in terms of what's happening in the commercial real estate market, we're still not sure, the directions, even though the buyer and seller expectations has been closing. We're seeing slightly more deal flow picked up, but we're not feeling very confident still in the market. We're the ones that's like, we don't want to take big risks because it's easier to lose, harder to gain. So with the economic cycles, unless we're seeing kind of a, obvious upward trend, we're not going to be investing as much in the equity position. We're be more investing in some of this more consistent, either very heavy cash flow based, like RV parks, mobile home parks, or debt based, like some of our debt opportunities between 10 to 16%. So that's why we like to say this, investors would be awarded for patience and the willingness to take quick actions when opportunity arrives. And emphasize patience and opportunities, and how we structure everything for ourselves as well is we want to invest in opportunities that has high interest, but also have some level of liquidity. So a big thing that we're doing is debt fund that with some type of liquidity component. If we see significant market shift, that we can have the time and go deploy into something else that can give us a bigger upside. So that's what I have on that regard in terms of Grace's story. And I can definitely go into some of the other aspects, and I have, presentation typically prepared for due diligence as well. But I know that Glenn has asked a question here. Hey, Micy, not sure if you're going to cover this as part of your or her story, but can you walk through the journey of how to get to 100% passive? For example, if I need 100K a year income, then 5% return, I need 2 million in active investments, and our return distributions going on. Maybe talk about how to get from your first dollar invested to this total for a W-2 employee. How long should a club member expect to take to achieve this? Okay, so basically, let's just say 100K. That's a good example. So I think two things that I forgot to highlight in Grace's example is, it's all about what you are running to do. In her case, she's doing kind of two things. One is passive investing. She had also a separate income stream that she was doing to help continue to expedite the ability, how much she can continue to invest on a yearly basis. Because even though she does work with a financial advisor and she does, her whole life insurance, taking loans from a whole life rinse and repeat to continue to take out money to invest in real estate, both from a whole life insurance and her real estate side is basically close to tax free. So that's one component, just figuring out other income source. But if you're like, hey, I just want to focus on what I'm good at. I don't necessarily want to go like start another career from another job. In this case, let's just talk about what you already have, 100K. So what Glenn said here, 5% return. I think that's a very low assumption. That's why when I say 10 to 16%, that's what you should be expecting when you come up with your numbers. So that's how we did when we came up with our numbers. Because when I looked at my portfolio, and Glenn, I know we had some conversations around this as well. Because when I start like taking all like how much stress, how much I need to have, and driving to properties, figuring things out on property management can take care of it, or just following up with the property management. I figure out what's that number, and the number was for me like it was like actually in the 20%, but I take out my stress is also valuable, and I was in 10 to 16% range in terms of, hey, if I can get a 10 to 16%, then I'll be good. So one thing on the debt side, fix and flip loan, whether it's right now or even interest rates were pretty low, right? I was just taking that as an example because like part of our debt fund, we do fix and flip loans. like 12% is pretty, pretty standard, even when interest rates were low, even right now, for fix and flipper. So, and that's pretty good, for first lien position too, which is fairly secure. So rather than saying, hey, I need to invest $2 million to make this $100,000 passive income, you know, which is a significant chunk. Depends on how much net worth you have. If you do 12%, what's 100,000 minus 12%? 1.2 million, I think. Divided by 12%. No, not even that. 800,000, about 833,000. So I did 100,000 divided by 12%. So if we can consistently get to 12% or between 10 to 12%, if it's 10%, it's about $1 million. So you're already like reduced your numbers by half. So I think the key thing is, but the thing is, you think about how the math changes. If you lose some of the money, you can lose that in a year, lose 50, 100, $200,000 in a year. So the point is, how do I find consistent, lower risk opportunities that has consistent income, at least for the part that's what you want to use for building income. And the other piece is going to be more, hey, maybe I have some of this play money. I'm willing to see the upside. I don't know if that answers your question, Glenn. Feel free to open up your mic here.
Yeah, maybe so I I know we could argue about interest rates and rates of return and so forth about what's the right number. I guess maybe the crux of my question for maybe on behalf of the club, since I get this question from folks sometimes privately, is regardless of what the rate of return is, how do I get started from I have not invested $1 to I'm now six-figure passive, right? Now, if you have a
Okay,
big enough nest egg, you can do it today, right? If you
yeah,
don't have
yeah.
a big nest egg, then do you have guidance for the folks here on what you think is for a typical W-2 a reasonable path to progress towards that, and maybe what kind of timeline you think that might take?
Yeah. So yeah, those are good questions. I would say, like with Grace, it took her 5 years to be passive. I think she could have done it faster, but it took her 5 years, mostly because she didn't want to like allocate like all her capital in one go. And I know people who does, like they will allocate like this, hey, this is such a good thing to do. They just start like putting everything there at once. She's starting on like a slower approach. And then and also as she had capital, she continued to do it. So we talked about, so from $1 to like 100K. So let's just get to $1 first. First is to fund something that you think is secure. If you're uncomfortable with an equity piece right now, a lot of you are familiar with multifamily. They're distributing cash flows like 2 to 3% a year, well, very low. Maybe invest in something that's like you're like the last person to get paid typically as well. After the senior debt with a bank, after pref equity, mezz debt, you're the last person. So maybe invest in something more secure, gives you a sense of comfort, understanding how the space works to take that step one. So invest in that first $100,000, So that would be the first step. So first you need to get from 0 to 1 and investing opportunities has lower risks. Like, because a lot of the investors who invested with us for the first time, like they don't take on high risk opportunities. At first I started on like auction properties and not a lot of people invested with me. And then I went into a little more less risky opportunities, more people are interested in investing with me because they don't want to take a high risk and they start seeing the cash flow coming in or interest payment coming on a monthly basis. That's where you start having a better sense of confidence and knowing that the downside protection, hey, the loan to value of the property, if I'm issuing a loan, is like 60%. If for some reason there's a market correction, I'm still protected. I think that's what helps you take that 0 to 1. So I don't know if there's any questions from 0 to 1 first, and then we can talk about 1, 2 mini.
Hey, Micy, Gary has a question on what's the minimum needed to get started.
The minimum is usually 75,000, but we also sometimes have 25,000 minimums, but with significantly lower returns. typically 75. But in general, I think in the syndication space, a lot of people are doing 50,000. And I kind of, spoke to the club so far with the assumption that people already understood how some of this passive investing works. Maybe I shouldn't have assumed, but that was my impression since Daniel has been doing all this hard work for the past couple of years. I assume everyone has some type of, understanding. But if you haven't taken that first step, my recommendation for you is to find opportunity that you think has really good downside protection. The likelihood of you losing money is low, and you can start seeing updates and interest payments or good cash flow coming in like within the first month. Because only when you get confidence that way, you can continue to diversify. So that's first step, 0 to 1. Now, and then let's, with Grace, she did about 12 investments, 12 to 15 investments or so before she became financially free. And even with her, like, it's not like all 12 investments is, let's say exactly 200,000 or 300,000. She realized that what was missing from her portfolio was debt based, because what happened between, just let's say 2019 all the way up until 2022, because of the appreciation in the market, a lot of people are investing in the equity, hoping that, properties will continue to go up in value until it started falling. So a lot of people are hurt from that, and a lot of people were used to that. They're not really thinking much on the debt side. So that's why she starts saying, hey, for what I really want to achieve, I just need a 10 to 16%, like I told you, figure out that number for you. If yours is higher, then you may have to look for higher opportunities. But for her 10 to 16% multiply, that was enough. So she basically took that criteria and invested in a bunch of those debt opportunities. So her debt and ATM, RV parks, mobile home parks, those are some of her heavy cash flowing opportunities. And then you have some of the other ones, short-term rentals. It's not as consistent, but it's performing pretty well in terms of its higher cash flow compared to multifamily. And we'll have some of this multifamily that's not as consistent. Like when you're investing equity, a lot of you, if you have invested, you probably realize the cash flow from the equity is not counted. You can't count on it very much, because it's like you having your own single family home rentals or duplex or smaller multi. When something breaks that month, like you need to take money from some of the operating reserves or some other places and go fix it. In Grace's example, it's like tree falling, leak, and relocating people to hotels, etc. Like there's always going to be expenses. Like it's harder to expect rely on those cash flows on a consistent basis, whether it's smaller repairs or larger repairs, unless you build a portfolio to such a larger amount that that the fluctuation is a lot smaller. So figuring out what that mix is for you, if you really looking for a longer horizon, maybe you don't need to invest so much in the debt piece. You can invest more on the equity piece. But for Grace, she was already like working 2 jobs, one as a pharmacist at a hospital, multi 6-figure income. The other side is like real estate avenger at night, doing other stuff. And when her kids knocks on her door, she's like, Mom, are you still working? She's like, my goal is to get to be as passive, as fast as I can without taking unnecessary risks. So, she took, when her plan was 5 years to get to that place, for her active investing. It took a little bit longer because she was learning and stuff. For her passive investing, she already had the capital. So you just have to look at on your portfolio. And this is something, hopefully, if you have a financial advisor, they can help you see as well. If not, at least you should have that conversation yourself with your partner or yourself, because not every financial advisor understands how alternative investing works, because, they're not incentivized for you to take money out of what could potentially be their part of management fee and say, hey, go invest somewhere else. So
Hey, Micy, a lot of people are, looking for partners or for people they can do that with. How did you meet your partner? What's the story there?
Oh, thank you. Yeah. We met at a mastermind in Florida about a year and a half ago in person. But before we chatted on Slack, because we saw each other and we gave intro, we were impressed with each other. But we met in Florida and we stayed in touch. And She was always a passive active investor, meaning, she wanted to be more on the due diligence and sourcing side because she realized how much work it is involved to actually being a sponsor, like reasons I said before. So she was really curious about that. I was working on a short-term rental fund space, so she worked with me on that. And during the process, we realized we had a lot of value alignment, and we're both hardworking and having good ethics and have very complementary skills. So if you're looking for a partner to do that, that's great as well. I think our partnerships has worked out really well so far. But it's not, it's less work, potentially better work, but it's definitely not no work or little work. We still, work, and me especially work a good amount in getting the systems and processes standardized. So right before that question, we'll cover 0 to 1 and 1 to many, but you have to figure out what a many is. And it's not always going to be a split, even 12 investments. So hopefully that helps.
Do you have any recommendations or advice for getting started this year? Any specific advice for 2024?
Yeah, I would go back to the part, if you watch what are the key market indicators, if you are not happy with what with the stock market in terms of volatility, the ups and downs, and I assume everyone here has a good understanding of real estate, the fundamentals by this point, and it's just really a matter of making the decision and find the opportunity. I'm not necessarily pitching my investments or anything, but finding something to test, like some of our minimums 25,000. You could find something out there that's a smaller amount of potential loss, but hopefully you don't have to lose, but just the downside protection. Be like, hey, let me just go test that, how that works, because I've done that. Like, that's what I do. That's what Grace and I do with our personal capital before, a lot of times before we bring to the fund. I would test how everything works. And that could be how it works for you. You just invest a smaller amount and see how that works. But I would say, focus on opportunities with good downside protection, capital preservation, again, as number one. We're big into that because it's secured by the building right away, first lien position, ideally. And number three, reporting and distributions. Because until you start seeing that coming in, everything people say is like, no money is hitting my bank account. Like, is this even true? I'm not sure. So, yeah. I think there was a questions about advice buying your next house. You could like your house to live in, or what do you mean? And
I think he's just asking about in general advice and whether a house should be one of the next things you buy. Maybe it's more of a an investment rental. Maybe you can comment just on the different sectors you think are doing well this year.
Yeah, the different sectors that's been doing well. Mobile home park, RV park has been doing well. Industrial has been doing well. Also, the debt piece has been doing well in terms of the real estate side. Strip malls are still pretty well. In the industrial side, there is a slowdown in development. I think some areas are being overbuilt. So those are some of the areas. Multifamily, there's a lot of areas overdeveloped. There's areas in Houston overdeveloped. You probably hear a lot of news from Houston investments. So the question going back was, as an investment, the question that and ask it, any advice for buying your next house or rental as an investment? I think it really varies based on your area. Like, for example, where I live, Northwest Arkansas, we've been having really good growth and we got lucky. Like, I purchased my first home in 2019 for 190K. I think right now it's like 350K in value or something like that. Like, the area is good, but when it comes to buying now or with cash flow, unless you do burr and flip renovation of any kind, most of the times it won't be able to cash flow. If you're holding the investment as a long-term appreciation investment, it's like you're buying a technology stock that pays almost no dividend, but you're like, I think it's going to grow really well. You can do that. There's nothing wrong with it, but you just have to be prepared on expenses. If you have no cash flow, be prepared to put money towards it and hope that you exit eventually on the other side. So it's definitely a riskier investment in my personal opinion. But if you have enough data points to suggest that you can sell at a good price, then it's great. Yeah, Glenn, thank you for clarifying. Anyone with BRRRRs, it's basically buy, rehab, rent, refinance, repeat. So essentially you're taking the ugly property, fix it up. After you fix it up and you get valued again to refinance some of the money you put in there. And then now you have the capital to do it again. And hopefully you have some cash flow when you rented out that property as well. It's
Hey,
definitely still a possible strategy. But I think it's
hey,
definitely
Micy,
harder.
you mentioned earlier, and I know just because we talk fairly often, that you're running your own fund. Maybe you could talk
Yes.
about some of the investments that you've made in that fund and why you think they're a good strategy.
Yeah.
Go ahead, be specific.
Okay. So we have already had outside the other investment we did outside the fund, within the fund, we have launched 3 and we're about to launch our 4th one. 3 out of the 4, they're a debt fund. The first one is essentially a fund into a operator that's a multi-billion dollar fund that all they do is first lien position debt. And what we liked about it was the fact that they had a super long track record. They've been doing this for like close to 10 years, and in a $1 billion, they're like top what is it, Inc. 5000. Yeah, that's the word I was looking for, Inc. 5000. So they're very credible, very good reputation as well. So that was like, and Grace, that was part of Grace's a good chunk of her passive investments as well. And the reason she liked it was because of the liquidity component. There was a 90-day redemption period. So about like within, after 90 days if needed. I mean, she's just putting her money there for quite a few years because she hasn't seen any other opportunities. That makes sense, but makes sense to move a large chunk of them out. But essentially that was the reason, relatively good returns, lower risk, and some level of liquidity. So that was a debt. And then the second opportunity, in terms of the debt, let me clarify, that mostly goes into multifamily and some of the development opportunities. That's who they issue the debt to nationwide. And the second opportunity was a mobile home park investment, more on the equity side. But because the mobile home parks are so distressed, the equity upside was very high, while the cash flow can still be like 6 to 8%, like starting the first year or so. So that was also attractive. Like the interest, or the cash flow wasn't that high compared to debt, but the upside interests us, and we know the asset class well because Grace runs a few mobile home parks herself, and she did a whole underwriting from scratch, and like numbers still checks out. So we wanted to have some type of that upside in our asset class. And the third opportunity, it was done through a relationship that I've established a long time ago. They're RV park operator. Essentially, they wanted to have us as a pref equity mezz debt for their RV park that they have already stabilized. By that, I mean, they purchased the property in 2021 for about $2.5 million. And that including purchase price and also renovations. And about 2.5 years later, the property is appraised at $5.2 million. And that's all from the operational, most of it from operational improvements of the RV park. And some of it is from, actually fixing up the place, etc. Because the evaluation of commercial real estate is all based on the income, plus what's going on in the market, how risky do investors sense about the market, which is represented via cap rate. So basically this RV park, they don't need a mezz debt because they don't need to refinance. They have about $2.5 million straight equity in this property, but they wanted to approach us to do the refund, to take out this mezz debt because they basically promised, not real promise, but based on their business plan, they projected to give investors capital back within about 3 years. So they're basically using this as opportunity to fulfill their promise to their investors, but meanwhile, establish a working relationship with us so we can do more deals together. So we basically issued a small loan to them. And with our small loan plus the seller financing that they took out in 2021, the loan to value was at 47%. We really like that opportunity because that means even if the market crashed by 50%, our money is still protected. And we don't think the market is going to crash by 50%, 50. So we really like that strategic relationship that we made. And that means, because they're going to refinance, well, not really refinance, but looking to take their investors out of some of the properties based on their agreement. So we're looking to do more opportunities with them where the loan to value is so low, they have so much equity in there. So we can take advantage of that for our investors with lower risks. And the last one that we're getting ready to launch here is similar, a debt fund that uses a interesting arbitrage that can get anywhere between 10 to 16%. If it's 75K or a higher investment, it's 14 to 16% in annual interest to our investors with what would be believed to be relatively lower risk, even though it's mezz debt, but because the loan to value and the loan to cost is relatively low. So those are kind of why we chose them. We look at the risks first and then consider the upside. I don't know if that.
Oh, I was going to say Nadosium has a question, or at least he's got his hand up.
Oh, okay. Do you want to ask Nadosium?
Oh, yes. Can you hear me?
Yes. Let me increase my voice.
I'm actually going to, it's in conjunction with Nicholas's question. He asked, you mentioned to understand the basics of real estate. Any idea on how to get started? So that's my question, along with also asking you how you started your journey, if you have any books or recommendations. But essentially, it's kind of, for me, I'm one of those people that I'm just like Nicholas asking in the chat. I'm still, I don't know anything about real estate, and we both would like to know how to get started on the basis, and also to ask you again how you started your journey, like where you went to learn stuff and how you got to the point where you are right now.
Yeah, thank you, Nadosium. Essentially, I got started by accident through house hacking. So if any of you are, usually if you're not married, I wasn't married at the time. And if you don't mind roommates, I was rooming with my best friends. I house hacked. I bought a house, the $190,000 or $85,000 home, like I told you. And basically I rented out the rooms. So I had an understanding how the house purchase process works. And then I went on to, after I got a taste of it, I want to do more. Whether it's continue to buy first primary residence or buy investment properties. So I think the first thing to do is really to take a step that's just a little higher in risk than where you're at by doing nothing, but just a little higher that you can bear the risk, even if you for some reason it didn't work out. Like I know I was like, well, even if I, like, for example, the house prices drop, I was like, I'll just stay in this house or I just rent all the rooms. I'll be okay. I'll just wait for prices. It was nerve-wracking, but I did that because I know that even if things change to a certain degree, I'll still be protected to some degree. And, we still have time and resources to make things happen. But the thing is, it's not like I put my whole life's worth within that one property, right? I just did. The thing is really about the risk. Like we're scared of taking risks because we think the risks is going to damage us so bad. But what if you really understand the downside protections? That's the key. So I would say understand the downside protections, whatever you will do. And if you're not going to house hack, if you're wanting just to do an investment property, do it with someone who has done it. Be a limited partner. You don't even have to invest in like our debt fund and things like that. It could just be someone locally, you've gotten to know them pretty well. Just hey, what about I invest in this property with you if you trust them well, just to get, so that I can learn the process with you. I can invest my money, but I don't get as much equities just for my, so you can take some of my equities as learning experience. I also invest in other, business as well, where I'm an LP, the people who's doing the day-to-day, they take a big percentage of it. So, you kind of have to pay your lesson somehow. Like, I paid through mentorship programs on a yearly basis, mentors on a yearly basis, giving up equity ownership so I can learn with people. So you have to learn somehow. The best way is learn while you earn and taking smaller risks. I don't know if that helps, but the big thing is reduce that risk and take that step.
Mhm. So quick follow-up on that. So to get the basics of real estate, you're saying you have to kind of just start doing it, like taking those little risks. Again, just to understand,
Yeah.
to get a better idea of those basics to build your fundamentals, of real estate.
Yeah, there's like the residential and commercial space have some differences and similarity. What I said about is just about taking that step. First of all, you do need to have some knowledge. How do you get to the knowledge? You kind of have two components. You could do, there's like a lot of people get started. If you want to do your own thing, you could listen to Bigger Pockets just to do, maybe like the BRRRR strategy that Glenn was explaining, or the fix and flip strategy. So you kind of listen to the books, audios to get an idea. And then the next thing is you go attend some meetings where people are doing those things already or trying to do those things. So you can be in that network and atmosphere because you're the average of the 5 people around you, right? That's why you're attending this meeting, because Daniel is awesome. He brings awesome people in, so you can become more awesome. So you definitely want to be around the good people, not the right people for what you're trying to do. And through that process, connecting what's in the book to what people are doing, and you can see if there is somebody you want to work with. Like, good partnerships are really hard to find. I've done quite a few partnerships with different people, and finding people that you eventually want to work with on a more consistent basis is hard. One way to reduce risks is to work with people in terms from a capital and operations standpoint. If you work with somebody else who has experience in finding properties and you have construction experience, so you're, by focusing solely on the area, you're reducing risks as well. So first, you can get some textbook knowledges, look on Bigger Pockets on fix and flip, or BRRRR strategy, etc. Try to figure out what might work for you. The BRRRR strategy is one of the easier ones. House hacking is one of the easier ones, even if you're married and if you're not, or have kids. If you're like needing to go to a bigger house because you just had a extra child, not extra, another child. No kid is extra, I shouldn't say that. Another child. You could, keep your old house as a rental. You can learn about how that process working with property manager. So you just have to figure out how do you want to get your experience. But remember, when you do experiences like that, when you start learning things on your own, it'll take time to take learning. So your learning will have to come, you have to pay your education somehow. And that's why in a lot of cases, like in our fund, some of the people we work with don't have much of real estate experience, and some of them do, but we do a lot of the white glove service for them as well. So it just depends on where you are in your life. Some people are just not in that space. They don't want to, listen to all these books and go to all these meetups or even attend Zoom meetings like this because they're like, I have something better to do on a Friday afternoon. And some of us, we have our desire to do specific things. We want to do those things, but it's not for everyone. You have to figure that part out too.
Micy,
Mhm.
I'm getting the impression that there's a lot of just general, how to get started questions there. Maybe we
Yeah.
could open up the audio. Take yourself off mute if you have a question, and we'll just go through questions quickly here.
Yeah, definitely. Yeah, feel free to open up if you have questions.
I noticed Ain has mentioned in the chat that he's learning about tax optimization and deductions and write-offs. Do you take advantage of any particular types of tax deductions or write-offs that you think are particularly valuable, Micy?
Yeah, the depreciations from my passive investments helps with some of my active investments in terms of the gains in the area. And I know Grace, I think she's a rep status, which is real estate professional status that Anne is mentioning. It's going to be harder for W-2 employees most of the time, but if you have, and you can't force your spouse to do this, but if you have a spouse that have some time and they have an interest in real estate, they can become an agent or help manage your properties. And a lot of times, it's not tax advice or anything, but you could potentially use a lot of the depreciations from the passive investments, which is real estate investments in general, against your actual W-2 income.
Another deduction I could mention is that a lot of real estate investors invest through an LLC or a company that they own. And of course, when you're talking about business expenses, Uncle Sam lets you deduct your expenses before taxes on a business, where they don't if you are running those expenses personally. So just standard business expenses that are deducted are a great benefit of starting a business to invest in real estate in.
Yes, that too, yeah. Business owner is definitely a different tax bracket. Yeah. Yeah, I think just figuring out where you're at in life, what you want, that's really the big thing. That's really important, because some of you may want to do active investment. That's what's important for you. Some of you may not want to do active investments. And figuring out that piece will help you set the path, because with there's difference between commercial and residential investments. The burst strategy, some things are similar and applicable, but there is differences in commercial investments and syndication and things you need to learn. So,
Hey, Micy, for those who are interested in getting started, who have been some of the largest and best mentors for you, or locations where you've got good starting advice?
yeah, actually, I didn't really know much about Bigger Pockets before. The only reason I say that is because a lot of people quote them, and then later on, went to some of the materials. I was like, it is actually pretty good. But for me, I started my first mentor is David Monroe. He's a CCIM who helped me really understand commercial real estate. It was a paid coaching course where I did tons of due diligence related work with him, understand market and dynamics and market research and comps and the entire due diligence process. And then from there, it was due diligence related to it was raising capital. To make a deal work, we need to have capital to make a deal work. So how do we bring the right capital in? How that process works? How to talk to investors? That was Hunter Thompson's course, raising capital for real estate. I was there for a year or two, and just throughout the process, it's just really about doing deals with people who has already done it. There's nothing better than that, because a lot of times, what you learn, you don't resonate right away until you actually do it. And right now, after some experience, really, I can, a lot of the people I can talk to, and I can basically learn from them, because I have something to offer to them as well from my experience and my network and opportunities as well. So at this stage, it's more like I don't really necessarily want to attend a coaching program anymore, because I don't want to repeat 0 to 1, or I just need to find the right resources, right people to get to the right places.
Hey, Micy, we've got 4 minutes left, and while we're still taking questions, how do people get in touch with you?
Yeah, thank you. Yeah, I almost forgot. So here is my contact if you want to. And that screen is popping here. This is so annoying. Okay. This is I have like 2 screens here. Up here. I don't know. Yeah, here.
I love the name of your company, Life Mission Capital.
Yeah, so that's my company, but I share very similar values as Daniel. Daniel's is Good Samaritan Capital. I don't remember exact motto there, but mine is to help people invest well so they can focus on what matters, which is their life mission. So I don't know why my screen's popping here. So I'm just staying on the screen a little bit. I'm gonna put my contact information in the chat since it's popping, like changing.
All right, do we have any other questions for Micy?
I will put my calendar here.
So can we have everybody take? Oh, go ahead.
Yeah, I was gonna ask. Yeah, Micy, with what you specialize in, do you do any like do you have any programs that or mentorship programs that you have for people that want to do like the passive investing? Do you have any programs like that, or is it what do you do you offer like programs or coaching for people?
Yeah, we're looking at launching something sometime this year, but we haven't actually got it out yet because we're busy laying up opportunities for the year. But if you want to get on our email list, we'll chat a little more, we can do that. It's very interesting. Coaching is one of the most profitable industries, like one of the most lucrative opportunities. Do you know why? Most of the times people who do coaching, they don't have to really promise any exact returns because individual results may vary. So we felt like it's an area that if we do well, like if we want to do it, we really need to put our hearts into it and have a small group of people that we can really nurture with. So or we can maybe just right now this year do like some type of smaller course, a little more e-learning based. So we don't have those details figured out, but you're definitely welcome to stay connected. And yeah.
All right, everybody, can you take yourselves off mute and thank Micy for coming in and speaking to us today?
Thanks, Micy.
Thank you.
Thank
Glenn.
you.
Great seeing
Thank you.
you.
Thank you, Micy.
Great
Thank you.
seeing you.
Thank you, Micy.
Thank you.
Next week, we've got Logan Freeman from FTW Investments coming in to talk to us about the retail sector.
Ah, interesting. Is Logan focused on the retail sector now?
Most of their investments are in that area now.
Ah, interesting. What happened to multifamily? They don't want to invest in that anymore? Or
Oh, they still have multifamily, but you can ask him those questions next week. Have a great weekend, everybody.
okay. Thank you, Daniel. Feel
Yeah.
better. Thanks for the opportunity.
Hey, Daniel, this is
Yes.
William. I sent you that email with the all the different with different links that I could find. It was an
Okay.
Excel spreadsheet, and so I didn't have all the current site doesn't have the previous sites, and then maybe on the Intel side.
Okay, I will check that out. I've got to end this meeting right now because I have somebody else who's running a conference and they're using my Zoom account.
Take
So I
care.
got to let him start his 1 o'clock.
All
I will
right.
check out your email.
All right. Bye-bye.